You're kind of the money guy when it comes to investors specifically.
So the more experience you have, the more that we'll give.
You want to be a serious business person? Start getting your ducks in a row.
Pretend you're lending your money.
Sure.
Right? How would you think about it?
The number one factor in real estate that stops people from buying properties is money. In today's podcast with Rich from RCN, we're going to talk about just that. How do you start with zero and build a multi-million-dollar real estate portfolio? This is all about commercial loans with Rich from RCN. Hey guys, welcome. Today we have Rich from RCN and we're talking about loans. So this is going to be a great podcast. So Rich, welcome.
Thank you. Thanks for having me.
So Rich, you're kind of the money guy when it comes to investors specifically. So let's kind of start there because there are maybe 3 or 4 different categories, right, of money. One is going to be your personal savings. 2 is going to be friends and family or private money space. Then you have residential loans, which are going to be Fannie, Freddie type of loans, which are very difficult to get unless it's a house you're buying to live in, right? Where do you guys fit? Because you guys are that 4th category of loans, which is more commercial loan, or a lot of people know it as hard money. What exactly is hard money?
Right. So we actually try to get away from the term hard money.
Okay.
I guess we kind of prefer, private money, I guess you could say.
Okay.
So it's a friendlier term.
Absolutely.
But we really concentrate on the short-term bridge loans, the residential transitional loans, we call them RTL loans. Those are typically like 12, 15, or 18 months. That's like your purchase and rehab loan.
So basically you're buying a property that needs a lot of work. Plumbing's not working, electrical's not working. There may be a hole in the roof, whatever it is, right? It's a messed up property. This is the loan you get for people who may be just listening that, oh my God, the property's so messed up, right? You go to Chase Bank, you go to Wells Fargo, you go to anybody. Normally, they're going to say, no, I mean, the property's messed up, not giving you a loan. So how do you do a fix and flip? Well, you go to a lender like you guys, and there are going to be 2 major loan products, right? One is going to be, I refer to as a fix and flip loan, right? Which is the property's messed up. I'm buying the property to fix it up. And at that time, I can either flip it for a profit or I can keep it as a long-term rental.
Correct.
Right? But if I'm going to keep the property as a long-term rental, I'm going to need another loan at that time.
Right.
Right? And so that's kind of the loan that you guys have, the front-end product, front-end meaning to buy and rehab, and then the back end, which is if you want to keep it for the long run.
Right. So we'll typically give between 80 and 90% of the purchase price.
Hold on.
Sure.
Let's break it down one step at a time.
Sure.
Okay. So let's just stick first to kind of categories of properties, right?
Okay.
Meaning, so I'll just kind of ask you those because I think for a lot of people that may be new, it's going to be a lot to take in, right? So when we talk about categories of properties, you have residential properties.
Right.
And when we're talking about it, so I like to look at your guys' loans as a commercial loan product. Right? Meaning this is not for a house for you to live in.
Exactly.
Right? This is specifically if you want to do a flip. This is specifically if you want to build up a rental portfolio.
Exactly.
Right? You want to buy a 2-unit, 4-unit. You guys will do up to 9-unit buildings.
Right. So on the purchase, we'll do, if there's a rehab component, like on these bridge loans, we'll even do more than 9 units.
Okay.
On the takeout, the long-term loan, we're going to be capped at 9 units.
Capped at 9 units. So basically, somebody wants to do a 20-unit messed up property.
Yeah.
They want to do a value add, meaning they want to do a lot of work, and they want to flip the property out on the back end.
Right.
You guys will give a loan for that.
Correct.
Right? Same as for a house that's messed up and needs to be fixed up.
Right.
For a flip. Right? Okay. And then, so let's talk about that part of it, right? We'll kind of call it fix and flip.
Sure.
You guys call it
RTL.
RTL.
Yeah.
What does that stand for?
Residential transitional loan.
Residential transition. So it's exactly what it sounds like.
Exactly.
Transitional meaning it's for a limited period of time. It may be 6 months, 8 months, 9 months, where you're fixing up the property.
Right. To get you to whatever your exit strategy is, whether it be hold or sell.
Okay, got it. So Now, when I come to you, let's just say I'm a new investor, right? I come to you and I'm like, oh my God, I'm excited, Rich. I found this deal, right? And a lot of times people are used to that I need a lot of money in the bank. I need, perfect credit. I need to have tons and tons of rehabbing experience. Because whenever you buy a residential house to live in, right, they're going to send an appraiser. They're going to do a home inspection. If it's a FHA loan, it'll be an FHA basically inspection when the appraiser goes through, and everything, even chip paint has to be painted. Right. So small details, but you guys don't care about that.
That's correct.
So what is the loan based on?
So the loan itself is going to be based on, the asset. We're going to take a look at the experience of the borrower. We do understand that we'll give people an opportunity that have no experience to still be able to give them the loan. The terms are a little bit different versus somebody that has a lot of experience. And of course, the FICO score, the credit score is very important as well. So we like to see that, higher than a 680 preferably. But, there's a little bit of wiggle room there. It has to make sense for us. If the FICO score is a little bit lower, but you have a lot of experience and a good track record, we understand. Right? A lot of investors, they'll use the credit cards for Lowe's and Home Depot and stuff, brings the credit score down. We understand. But if you're a brand new investor, it would be good to have a higher credit score.
So, and I want to kind of bring this up, guys. This is something that is important to understand, right? See, how do you build faith with a financial institution? How do you build trust with the financial institution, right? There's only two basic ways. Number one is, what is your experience? Meaning, if you can truly show that you were either a partner on paper, not where I shook hands with my friend, on paper, because they want to verify, right? They will trust you, but they will always verify that, hey, is this for real? Because you wouldn't believe it, people make this shit up, right? I mean, this is just how it works. So that shows experience, right? That's one big factor. They're like, okay, this guy has done a lot of deals. So we are willing to give him a loan. Why? Because he has experience. If something goes sideways, some problems come up, he can handle it, right? And the budget he's giving us is a realistic budget. That's number one. Number two is, you don't have to have perfect credit, but you need decent credit. Right? Now, you throw out a number 680. Right? 680 is good credit. It's not great, but it's pretty good credit. Right? And this is something that a lot of times people have to understand. People will be like, but Andrew, if I messed up credit, I'm a good person. You may be a good person. It doesn't matter. Right? But you clearly can't handle your finances. Right? I mean, this is just a fact of life. And I'm sorry if I'm being rude, but it's just a fact of, and I've been there where in college I bought a bunch of stocks on credit cards, right? I mean, I was Mr. Entrepreneur, right? And I ruined my own stupid credit. Not proud of it, but that's what I did, right? But then guess what? At some point, I'm like, hey, I got to fix this because this is not something. And understand that if you want to build a business as it relates to real estate, you're going to have to fix credit, and you'd be shocked how quickly, if you really get hell-bent on it, in a short period of time, relatively, you can actually fix your credit. A lot of times people, and I ran from it for years because I was like, oh my God, I'm embarrassed, right? And I didn't want to address it. And then I realized that this becomes important. So if you do have, let's just say, because sometimes people have dinged up credit for whatever reason. They go through a divorce, there was some other issues, whatever, right? Can they partner with somebody that has good credit and still be able to do a transaction?
Yes.
Okay.
Yes. So, the partnerships, I would say, is a very common component to a deal. A lot of times, you'll see 2, 3, 4 partners in a deal. Maybe everyone brings something to the table. One guy has the money, one guy has the credit, one guy has the experience. And they're able to get the deal done together. That is very common.
And there's nothing wrong with that, right? To start out, sometimes you may not have the reserves, right? You may not have 20, 30,000 in the bank. That's okay. Nobody's judging you. Just understand, what is an entrepreneur? An entrepreneur is somebody who has an idea and they either partner with or use another person to build value. In our business, how do you build value? If you know how to find a great deal, right? Let's say I go to Rich and I are friends, and we're like, hey man, you want to do this deal, right? I found a good deal. I'll do the work. I'll make sure I sell the property. I have a real estate license. I can sell the property. What is my value add? My value add is I found the deal, number one. Number two, I'm willing to get the work done. I'll take on all the headaches, right? And then I can put it on the market. I don't have to maybe charge a commission. Whatever the value is, there's a value proposition. And then I may get to Rich. Rich is like, hey man, I'm full-time loan officer. That's what I do. I would love to do this. I see a lot of people. He has experience. He sees a lot of deals, right? He brings industry knowledge to me, which can be of value. Says, hey man, I got $30,000. I can put that money up as a down payment, as a part of the rehab. Now we can do that deal together. Right. And whatever you work out with them, if you split the profits 60-40, 70-30, and maybe he has a little bit better credit. Maybe I have a little bit better credit. A lot of times people are like, well, I don't have it. So, guess what? Only rich people get there. Well, no, that's not the point of this. The point is, in this particular case, a commercial lender like them, right, is willing to work with you even if you don't have all the perfect pieces in place.
Right.
Right.
But as long as a whole,
it makes sense.
It all adds up and makes
Correct.
sense.
Exactly. So I can have part of the pieces, he can have part of the pieces, and they will help you put that together. Now, whenever somebody's borrowing loans from you guys, do you guys give the loan in the individual's name, Andrew Holmes, or does it have to be an entity, LLC, or a S corp or something like that?
We always like to see it in some sort of business entity.
Okay,
yes,
got it. So they don't have to form anything very fancy, whatever state they live in that state. All they have to have is either an LLC or an S corp, something fairly simple, nothing complicated.
Correct.
In the state you live in and where the property is.
Correct.
Right.
Yeah.
Besides that, so number one, you look at credit.
Yeah.
Credit 680 or up, preferably.
Yes.
If not, you can partner with somebody. Right. How important is experience?
It is very important. As a borrower, you're normally looking to, from what I see, to be able to take advantage of the most money you can acquire from the lender. So the more experience you have, the more that we'll give.
Okay.
Right? So the experience does come in handy. It makes us feel more comfortable when you do have a proven track record.
Sure. So experience, does it have to be real estate, meaning does it have to be real estate ownership or partnership in deals? How about if somebody says, well, I'm a contractor?
Right. So even though the contractor is obviously experience, it's not going to be experience on paper that we need. Because it's not a deal that the contractor has done for himself.
Right.
So, I do get that from time to time. I've never done one myself, but I've done 20 or 30 projects in the last 5 years for others. We can't count that.
So that doesn't count towards experience, but that doesn't mean they can't get a loan.
That's correct. That does not mean
so the way a lender like them, commercial lender, looks at it is that the more experience you have, the more favorable terms you're going to get.
Correct.
They're not saying we're not going to do a loan for you, but as you get more experience, you basically get more cookie points or bonus points because you have more experience.
Right.
That's really what it boils down to.
Right. The leverage will be higher. The rates will be a little bit better, which is what everyone's looking for.
Sure, absolutely. So what else are you looking for? So whenever somebody... a lot of times whenever basically kind of commercial lender like you comes in, they're like, well, we're giving you the loan based on the property.
Yeah.
Right? Now, the property is important. So if a property is messed up, right? It has, the plumbing needs to be redone, the electrical needs to be redone, maybe the roof is in bad shape, maybe it's leaking a little bit. The property is messed up. Then how are you underwriting the loan based on the property?
Right. Well, we're gonna care about, like, for example, the neighborhood that the property is in.
Right.
Right. It's if the neighborhood is a tough neighborhood, it's harder to do a rehab there. Sure. Right. Would you agree? Right. So we would want to see some experience from the investor in a neighborhood like that they have some success there. Mm-hmm. If they haven't, that probably wouldn't be a good deal for a first timer through our eyes. Right. Right. What I typically do is like we'll do like on Google we'll do a drive by around the neighborhood and we'll see, if you're buying the one and worst house on the block, we like that. If it's a nice block and you have the bad house, that's great. If it's a block that has boarded up windows, all throughout the block, that's not necessarily a good look. You might have gotten a good deal on the property, but that property is going to be tough to sell. It's going to be tough to rent. The exit doesn't really seem too sturdy.
So, and this is important to understand. So imagine you have a nice area, right? And you can have, like, I'll take Chicago as an example. You can have there are parts of Chicago which are tough. It's just a fact of life. You and I can't change it. That's just how it is. But in those areas, you'll have 2 blocks where there's a lot of multi-unit buildings. You have a lot of single families across the street. A lot of the multis are all boarded up, right? Because they're just devastated. Yet you go 2 blocks away, you have beautiful blocks, right? And the neighborhood is great. The comps are strong. Properties are selling, right? So even though the area is like, but when you go there, you clearly see that difference, right? Right off the bat, you see the difference. So if you're there and you have lots of other comparable properties that they can look at and go, oh my God, okay, so this is the block, this is part of town, but this is the area, and a lot of properties are selling. But around if you're on a block that is really, really bad, and you have the idea of, I'm going to change the neighborhood, right? Good for you, right? It's fantastic. You have very idealistic goals. But guess what? From a lender's perspective, they're going to be like, yeah, that's all fine and good. But you ever done that before, right? They're going to be obviously kind of stringent on their standards. That you can't have credit that's not good. You don't have a lot of liquid reserves. You don't have anything, and you're going to basically change the world. They're going to basically say, no, that's not going to work. Correct?
I usually like to say, pretend you're lending your money.
Sure.
Right? How would you think about it? Would you want to have a lot of would you like the borrower to have a lot of reserves?
Sure.
Obviously, if something goes wrong, you'd like them to be prepared.
Sure.
Right? So this way, just in case, they can make payments, right? And everything will be smooth. So always look at it as, if you're lending your money to somebody else, what type of things would you have in place to kind of make yourself feel more secure about lending that money?
Right.
Yeah.
100%. So you have to use a sense of reasonableness at times, that they're willing to look at a lot of properties. Now, if on the other side of it, you're in a really nice area, but your property is kind of messed up, see, they're much more likely to look at it that, oh my God, the area is so nice, right? All you have to do is fix the property. See, the property somebody can fix. The area, unfortunately, you can't fix. That's a much more long-term, sometimes political, a lot of other issues that are out of the investor's hand. Right? And so all those factors are taken into consideration holistically whenever you're getting a loan. Now, from a borrower's perspective, right, initially, especially when I did my first loan, it was interesting because I remember I paid 3 points on the front end, and even though this was a fix and flip loan, I had a 3-2-1 prepay. Okay. So basically what that meant was, even though I was going to pay it, I paid 3 points to get the loan. And then when I sold it within less than 6 months, right? Actually, I sold it in 4 months.
You paid a penalty.
And I paid a 3-point penalty, right? I just didn't know any better.
Sure.
I had no idea. And I thought that's the best I could get. Right. And I was grateful, mind you, to get the loan, right? Yeah. Because I didn't know any better. Because this can be, for us, it's easy to talk about. But for somebody who's new, this can be an overwhelming process, right? So as far as paperwork was, I call you. I'm like, hey, man, I heard you talk on Cashflow For Life show, and I want to get my first loan done, right? Get started. As far as paperwork, what do I have to fill out?
So you're going to give me your contract, show me that you're in contract. We have a rehab budget template that we like filled out on our template. So I would give that over to you. You'd fill out your entire rehab budget. We'd take a look at the work that you're going to be doing and what the cost is going to be. Sure. Then we're going to run numbers, make sure everything checks out there for us and for you, the investor. And then and then we kind of roll from there. I'd like to have your entity documents in place as well, before we start. And then I'll order up the appraisal, we order title, and we get going. And we usually look at like a 2 to 3 week close.
So you guys are they're going to have to fill out a PFS, personal financial statement.
It's not necessary on all deals.
Okay.
We do require a bank statement.
Okay.
After we get the process going, so bank statement is going to be the proof of liquidity. We also take like retirement into account as well.
Okay.
Sorry, so we can do that.
Okay, got it. So basically, let's just go through some numbers, right? Let's just say I'm buying a property for $150,000. That's my purchase. I don't have experience.
Okay.
Right? I'm a new investor.
Brand
let's
new.
assume. I'm going to do a fix and flip.
Yeah.
I'm buying the property for 150. We'll keep the numbers even. 50,000 is my rehab budget.
Yes.
Right? I'm somebody new, got a credit score 690.
Okay.
Right? And I come to you. So at that point, what happens?
So I'm going to take a look at the property. Okay. We're going to make sure that it's not in one of those like tougher neighborhoods, because we don't want you to see your first one in one of those types of areas and it'd be too difficult. So assuming nice area, suburbs, we're going to like we said, run the credit, take a look at the rehab budget, analyze the numbers. Now, what you would typically qualify for as a brand new investor with no partner with experience or anything like that, you'd probably be at a 25% down payment.
Okay.
We would cover the rehab cost, okay? That's going to be taken in draws.
Sure.
So you're going to start the rehab with your own money.
Sure.
And then you're going to collect draws after the property's inspected and completed work is finished. Now, the entire loan amount between what we give you for the purchase and the rehab, it cannot exceed 65% of the ARV.
Okay.
So the max loan amount will be capped at 65% of the ARV for a brand new investor.
Okay, so let's take it one thing at a time.
Yeah.
Right? The first thing is you said because I don't have experience.
Right.
Right? Because I don't have experience, I need 25% down payment.
Correct.
Right? So 25% of 100,000 is going to be 25,000 plus, since I'm buying the property for 150, and I'm going to do $50,000 in rehab.
Yeah.
So is it 25% of the 200,000 or
No,
is it
It's 25% of your purchase price.
purchase price?
Right.
Okay. So basically I need about 25,000 plus probably another 10 or 12,000. Right? So about 35, 40,000 bucks. Is that correct?
I think we might have skipped something with the math there.
Okay.
So 25% of 150 on the purchase
150,
price,
correct.
right?
Yeah.
So we're looking at about
40,000
there for that.
Yeah, 40.
Oh, okay.
And then how much extra do I need on top of that?
Okay, so we'd like to see 9 months of payments in reserve.
Okay.
Between 9 and 12.
Okay.
All right, but that's not going to be collected or escrowed or anything. We just want to see that there.
That you have an ability to be able to make payments.
Yeah, so let's call it for like a newbie investor, like 12 months of payments on the side that you could show us that you have.
Okay.
We'll want to see that you have at least 10% of that rehab budget to start.
Sure.
So that's another $5,000 there
Sure.
that we'll throw in. And then we'll want to see that you'll have enough for all your closing costs.
Got it.
So the total liquidity number is going to be your closing costs, your reserves, 10% of your rehab budget, and your down payment.
Got it. Okay. So that's the amount of money. Now, let's just say hypothetically, I have 56,000 in the bank,
Okay.
right? And I don't have the rest, right?
Yeah.
But I have a buddy that I'm doing the deal with.
Yeah.
That's my business partner. He has a little bit more.
Yeah.
Will you take that into consideration?
We will if you partner with him.
If you partner, okay.
Right. So if he just throws $10K in your bank account,
Right.
that's not going to work.
Okay, got it.
So if he's a member of your entity of at least 10%,
Sure.
we'll go ahead and honor his liquidity.
Got it. Now, how about if I have, let's just say I have a small 401k.
Yeah.
I have a $80,000 401k.
Yep.
Right? Will you consider that?
Yes, we will consider half of it.
Half of it.
Same
okay.
thing with like stocks and.
So
and
I don't have to go touch it.
Correct.
But you guys will take the value. So a lot of times people will have, they work for a company, whatever, or they have some stocks, they have some other things. Of the 401k value, let's say you have $150,000 in 401k, you'll take half, $75,000, you'll give them credit towards their liquidity.
Correct.
Okay, got
Yeah.
it. Perfect. How about a stock portfolio?
Yeah, half.
Same thing.
Half, yep.
Same. Okay, got it. So because that's a non-liquid asset, you're basically discounting it a little bit to give credit.
Yes.
Right. But somebody doesn't have to, because a lot of times people in a situation, they say, man, I have some savings. I can cover the closing costs. I can cover the down payment. I'm all good. And next month, when I get my paycheck, I'll be able to do the rehab. I'm going to put a little bit on my credit cards, and I'll get it done. And payments is no problem, right? They have good credit history. And a lot of people in that situation, right? That they may not have that much liquidity, but they may have a 401k, they may have stock investments, blah, blah, other things. You're not asking them to liquidate anything.
Right.
You're just saying, hey, show us that in case money is needed, you'll be able to come up with it. But if you have regular good monthly income, and you can swing it. And a lot of us started that way, right? Because I literally, on the first deal, had to scrounge up every little penny, and I basically took on a partner. He put in 20,000, I put in 20,000, and that's kind of how I got started, right? And there's nothing wrong with that. That's a perfect way to get started. You do 2-3 deals that way, and then off to the races.
It's a very common scenario to have enough liquidity to cover your down payment and your closing costs, but maybe not have the full amount to cover the reserves.
Sure.
And then that's where the retirement comes into play, and that'll just kind of cover, be a nice buffer for the reserve number.
Got it. Okay,
very
perfect.
common scenario.
Okay, perfect. So that is now. How about if I have experience, right? I come to you and I say, hey, man, I want to do a fix and flip loan, right? I can show hundreds and hundreds of transactions. But what is the threshold for you guys to say, yes, this person has experience, I don't need to see anymore, we're good to go?
So 3+ pieces of experience, and for us, experience is completed rehabs.
Okay.
So if you bought a turnkey rental that you didn't rehab, we're not counting that as experience, even though it's part of your portfolio.
Right.
So rehab projects completed in the last 3 years is what we're looking at. And if you have 3, we consider you experienced.
Got it. Okay. So what happens if I have experience for you guys? I mean, in terms of my interest rate, in terms of, is it easier for me to qualify? Like when the credit committee looks at it, they're like, yeah, this guy's done, 10, 15, 20 flips, 40 flips, whatever it is, right? Or they bought the property all messed up, fixed it all up. You guys came in and did a refinance. Does that count also?
As experience?
Yeah.
A refinance wouldn't technically count for your.
But what if I did all the rehab on it?
Yeah, well, then that rehab would absolutely count.
Okay.
Yeah.
And
so the property does not need to be sold. That's a common misconception, right?
Sure.
Where it's, did I flip the property and that counts as experience? It's just the rehab completed.
Got
A lot of people want to hold, and that's fine. And that counts as
it.
long as the rehab was done.
Got it. Okay, perfect. So as far as, so in that case, that experience will count, and that helps me in terms of getting a lower down payment.
Correct.
What does the down payment go down to?
15%.
15%. Okay.
And when I mentioned earlier on the newbie program that the max loan amount is capped at 65% of the ARV, well, now you'll be capped at 75% of the ARV.
Got it.
For the max loan.
Okay. So basically more avenues open up for you to be able to, kind of get to be able to leverage your money better.
Leverage is higher, rates become lower.
Right. Okay.
Yeah.
Got it. That makes perfect sense. So let's talk about let's say I'm not doing a fix and flip.
Okay.
Right. Actually, I forgot one thing. What is the term of the loan? Meaning, how long can I borrow the money for, and how quickly do I have to do the fix and flip? Buy the property, rehab it, resell it. What's the general loan for that term?
So it's a 12-month loan with a 1% extension at the 9th month.
Okay,
that's typically the situation. Now, if you have a lot of experience and you feel like you're going to go past month number 9, we'll probably be able to waive that 1% extension. But for somebody that's newer or that doesn't have a track record with us, you want to think about it like it's like an 8-month loan, basically.
8-month loan. Okay, got it.
Yeah.
So generally, let's just say I'm doing a bigger project. I know I need to pull all permits, blah, blah.
Yeah.
But the numbers are good on the property, right? But I got $150,000, $180,000 of work to do.
Yeah.
And I'm like, hey, man, it's in certain town or city, whatever, and it's going to take a little bit of time. I need architecture drawings. I need this. I need this. I need this, and it probably is going to be a 10 or 12 month loan. I can talk to you guys up front.
You can.
And as long as I have experience, as long as things are good, you guys will work with that.
Yeah, and I always recommend if you feel like you're going to be in that 10 to 12 month range, we actually have a 15 and 18 month program as well, and you're probably better off just
going
to
into
go
that.
right into like a 15 month. If you feel like it's going to be 12, just be safer and go into the 15 would be my advice. Yeah.
Okay, got it. And now, as we talk today, right, we're talking about middle of 2024.
Yeah.
Right. And the reason I'm saying that, I'm putting a date to it, is because interest rates change.
Sure.
Right. And this is something important to understand. Like a lot of times, well, what's the interest rate? Right. I mean, that's the first thing that people think about. And a lot of times I'm like, listen, interest rates 2 years ago were 2-3 points lower, 2-3% lower. Right. Today, the interest rates are whatever. Look at your residential interest rate and then add at least a point and a half to it. I mean, a percent and a half to it. Right. At least. That's just kind of what it is. Right. And in fact, today, the residential rates that you're paying for your home are pretty close to what the commercial rates are.
Yeah.
You know, used to be when the interest rates for homes was much lower, there was actually more spread. Now that spread has in fact come much, much, much closer, right?
Yeah.
So right now, what are the rates running on a fix and flip?
In the 10s.
In the 10s,
yeah, so like 10.5% I would say is a good number to use.
Got it.
If you have experience and a good credit score.
Sure. Okay. Otherwise, it's going to be closer to 11.
It'll be probably 11.5.
11.5.
Yeah.
Okay. Got it. And just understand, guys, if you're doing a fix and flip, you're paying that rate for 6 months, 8 months, 3 months, 4 months, whatever it takes you to buy the property, rehab it, and resell it, right? This is a lot higher, riskier loan, right? So yes, the interest rates are going to be higher, right? And if that's not something that you're okay with, guess what? Save up money and go do it 10 years from now, right? I mean, that's just how it is. And a lot of times people go, well, I'm looking for 7%. Good luck. If you find it, please let me know and let him know, right? You're not going to find it. The rate on a commercial lender is what it is. That's just how it is. And a lot of commercial lenders are going to be fairly similar. Some people may be easier to work with. The reason we work with RCN, they're a long-term lending partner. They do a lot of loans. And a lot of times, once you know what to do with them, and generally, you don't want to go from a lender to lender to lender shopping rates because you're going to kill a lot of time. And you have to understand that sometimes, yesterday we were having this conversation about another lender we work with, and sometimes somebody's going to be an eighth lower. Sometimes they're going to be a little bit better because the market ebbs and flows, and the companies that are behind them, they can't be 2 points off. That's just a fact of life. Nobody's going to go give you the business. But is it going to ebb and flow? Yes, it will ebb and flow. But generally, I believe once you have a relationship with a good lender, you want to stay with them because every time changing paperwork, changing all that stuff, it creates havoc and it's going to slow down the efficiency of you building a real estate portfolio or you doing business.
Right. I agree. Yep.
So let's talk about a rental loan.
Okay.
Right? I have bought the property. I have fixed it up.
Yeah.
Right? And now, so on the front end, I took a loan from you guys or I had a private money loan on the front end. On a rental loan, how do you guys look at it?
Sure. So the rental loans are DSCR loans,
It's
right?
called the technical term is a DSCR.
Correct.
Right? I'm calling it a rental loan for a reason because that for a normal person, they're like, oh, okay, this is for a rental property. Just think about it that way.
Right. And for the folks out there that aren't familiar with DSCR, so that's a debt service coverage ratio is what that stands for. And very simply, we're just taking a look at the cash flow of the property.
Yeah.
We want to look at that principal, interest, taxes, and insurance payment, put it up against the rental income, and make sure that you do have some sort of cash flow coming in every month. In order for us to figure out a loan amount, you'll have to have at least like 5% at minimum cash flow on the property versus your monthly payment.
Correct. And this is something that, so just you have a single family ranch, you're getting 3-bedroom, 2-bath, let's say, you're getting $2,500 in rent. Right. And when you take your principal, interest, taxes, insurance, and you add all of those things up, and your payment is $2,600. Well, you're getting $2,500, and your payment is higher than that.
Right. So
guess what?
Right.
That's not going to
That's
work.
not gonna work.
Right? It's really that simple, right? And you're like, but Andrew, I can afford to put $100 out of pocket. You may be able to very well afford it, right? But that's not what they're going to give you a loan on. Why? Because the property in itself does not stand on its own 2 feet. Is really how you look at it. Is meaning if you're taken out of the equation, something happens to you, whatever your situation changes, the property by itself needs to make sense.
Right.
That's an easy way of understanding
It
it. Is that, and in our words, we'll say, does the property cash flow? Meaning, you bought the property. Now, if you say, Andrew, my rent every month is $2,500, man, it cost me $1,800 to carry the property, principal, interest, taxes, insurance. Beautiful. You guys would be like, hey, man, that's what we want.
Right. That's a strong DSCR.
It's
Sure.
a strong, and it's a business, right? They're helping you run your little business. This is your little property business. And so then it needs to be a profitable factory. That's how you have to think about it, is that it needs to make sense.
Yes.
Right? Now, with a rental property, right? If we just use a simple example that we had used, 150 purchase, 50,000 rehab.
Yeah.
So I'm in that particular deal for 200,000.
Right.
Plus whatever my costs are.
Yeah.
Right. Let's just put another 10,000 to it. Okay. So my cost of ownership so far has been $210,000.
Okay.
Now I come to you and I'm like, Rich, man, I think the property's worth like 320, 330. Right. You do an appraisal, the value comes back at 330.
Yep.
Now, how much can I refinance on the property? My cost is 210 on it. How much can I refinance?
So the maximum that will allow for with taking cash out, if you have enough room to get cash out, then 75% of that new value is our cap.
So
okay?
330 times 0.75.
Correct.
That's really that simple.
That's it.
Right? So 75% of 330,000 in this case,
yeah.
right, is what you can refinance.
Right.
Right? Is what you're going to be able to get out. So basically what that's going to mean is, if I get my calculator out, 330 times 0.75. So
right.
that gives me 247.5.
Right.
Is what I can refinance.
Right.
Now, that's up to that number.
Yes.
Right? So explain, what do we mean by up to that number?
The option is available for you to take less and leave the equity into the property instead of taking the cash out.
Got it. So now, but that's one test is 75%.
Yeah.
You have another threshold test, which is the cash flow has to support
yes.
what you'd refinance.
Correct.
So how does that work?
That's going to, again, come right back to that DSCR that we were just discussing. So there has to be enough cash flow for you to be able to have a loan payment for a loan of $247,000. So whatever that payment is, that cash flow is going to exceed whatever your monthly payment is. Your rental will exceed whatever the monthly payment qualifies for.
So what that means is this: like in this case, let's say we have a $247,000 loan, hypothetically, right? I have $900 in taxes. I have $5,600 in insurance. Sorry, $5,600 in insurance, about $900 in taxes, whatever. My payment is $2,272.
Right.
Right. Let's just make it $2,200.
Okay.
Right, as an even amount. Now, if my rent collected on the property is barely $2,200, right? You guys might come back and say, Andrew, we can't quite give you $247. We can give you $240. Because our number, so there are two threshold tests. One is the 75% of appraised value. That's number one. And number two is your cash flow, meaning based on the total rent you're collecting, based on the payments that you have on the property, those two things have to make sense as well.
Exactly.
Right? And is there a ratio, your DSCR ratio, which for some people, it'll be too advanced, so don't worry about it. Just think about, hey, I make $2,000 on the property from rent, and I need to be at $1,800. I need to have a little bit of money that I'm making for the property.
Yeah.
Right? So what is the DSCR ratio for you guys?
So it does vary depending upon your credit score.
Sure.
But it's between 5 and 15% cash flow.
Okay, got it. So basically just look at 5 to 15% cash flow and that's that.
Right. And
Okay.
and most of the folks are conservative, and when they're getting into their project originally, they're aiming for like 30% cash flow on the back end.
Right.
So normally we do hit those numbers or get close to,
Sure.
between 20 and 35%, let's
Right.
say. But sometimes it doesn't work that way, and we will go all the way down to 5.
Got it. Okay. Yeah. So generally, if I have a property where my payment is, let's say, $22,000, right? Generally, I don't feel good unless my rent collected is at least $2,700.
Right.
Right. That's just, and even with today's interest rates we're talking about. So if I have to borrow a little bit less money, I'm going to borrow a little bit less money on my refinance, because in this case we had said purchase 150, rehab is 50,000, 10,000 carrying costs. So actually, I only need to borrow 210.
Right.
I don't have to borrow 247. Correct. Okay. So besides that, anything else that I missed? How about what is the seasoning period? Meaning, I bought the property January 1st. I get the rehab done quickly. How quickly can I refinance the property?
Okay, so there's going to be 2 different ways to look at this. If you bought the property with a loan, and you do want to cash out, it's 90 days seasoning. Okay. If you just want to do a rate term refi, which I'm going to get into in a moment, there's no seasoning for that. Okay. So if you don't need the cash out, there's no seasoning. You finish the project in a month, let's say, and you're ready to refinance. We can do it. We can do it in a month.
Got it.
After closing.
Okay.
Now, something that RCN does have is we do have a pretty high leverage bucket for the rate term refis.
Okay.
I noticed that a lot of people in Mastery, they are able to acquire 100% financing on the front end, and all the rehab included, and maybe sometimes even the closing costs. So they don't have that equity in the property from their down payment. When they do look to hold on to the property and do a refinance, it's going to be a little bit tighter on that DSCR. And in order for them to get the majority of their money back or all of their money back from that 100% financing transaction on the front end, they may have to go past 75% of the new value of the property, up closer to 80%, to be able to get all that money back. So we do offer 80% LTV on the rate term refis, which I think comes in handy for a lot of the folks that are in your class.
Got it. That makes a lot of sense. Anything else that I may have missed?
I don't think so. I mean, because we have, such a big audience here, I'd like to just say that, and you can attest to this, the process with us, I feel is pretty smooth. We normally get our closings done in 2 to 3 weeks if the appraisal comes back quick enough and the paperwork is in. We're a pretty fast close. But as far as like the DSCR product itself, I think you covered everything.
And generally, your first loan obviously is going to take a little bit of time, right? Not only for them, but even for you. So the more time you give, if it's a fix and flip or but once you get used to the paperwork, once you know, okay, I need to have everything filled out properly, I can send them the insurance documents, I can send them the bank statements, I can send them get all the title work done, right? There are about 5 or 6 important docs on your end that you need to do. The more organized you are, the more you put things together better. And I've gotten much better at it. Right? Because sending 1 and 2 things, you make your own life difficult and you make their life difficult. Because now the back and forth, you lose a lot of time in. Right? So the better you start becoming at it and the more efficient you are. So this is for those people that are a little bit more organized, right? And I had to learn this the hard way, that whenever I'm sending documents, much easier to put everything all together at once, the lease, everything, try to give as complete a packet as humanly possible. You'll make it a heck of a lot easier for yourself.
Right.
And they don't have to go hunting for documents all the time.
Right.
Right.
I completely understand that, as investors, you guys are very busy.
Right.
You're on the grind all day long. You're out and about looking at properties, doing stuff. And the paperwork is the last thing that you want to do. Right. So organization is is a very important part of it. You know, you're going to want to have a folder set up on your computer, you know, with the property, with all the documents that you have. You know, keep it, store it. I don't think I've ever met anybody that wanted to do one property and it was their plan to do one and be done.
Right.
You know, everyone has goals
Sure.
to build a portfolio or
Sure.
do a lot of flips. So the more organized you are, when you can just go right into that folder at home and grab whatever it is you need and just, you know, conform it in an email, put it in an email form and kind of send all the documentation over to us, it's going to be a lot easier for you to just be organized. I guess that's the main point.
Yeah, I mean, and this is something that's really, really, really important because a lot of times, and I've heard this a million times, well, you know, the lender really is slow. They don't want to do the work, right? I mean, guys, just please understand. Lender is a business of closing loans, right? And 99.99999% times, the only now, if an appraiser is delayed, right? The lender can push them, but that's all they can do. It's
Right.
not in their hands, right? Generally, from a lender and from someone like Rich's perspective, they're not getting paid until they originate the loan, right? I mean, this is just how it is. It's a sales business at the end of the day. And if you don't meet all their requirements or if they've asked you for additional paperwork, why does a lender ask you for additional paperwork? Well, you didn't make a payment. You missed something. Your bank statements are light. There's other compensating factors that they need to show to give you a loan, right? This is just, so I know I've gotten mad at lenders. I got to take it out on somebody, so I'm taking it out on them. And we all do it. We're irritated about something else. We all do it, right? I'm no exception to this. But at the end of the day, it's not them who needs the money. It's you need the money. They would love to underwrite the loan because everybody that's working in the loan department, that's how they make money, is the more loans they do. But it comes down to us to, you want to be a serious business person, start getting your ducks in a row. The better your ducks are in a row, the better it is going to be and the easier it is going to be for you to borrow money. It's really that simple.
Right. And don't feel, you know, like you get a doc list from us when we start
Sure.
the loan that you have to have everything, you know, within 24 hours. The appraisal is going to take a good week to 10 days to come back. That's your time frame, right? You know, I mean, I'd love to have everything within the first week, but you have until that appraisal comes back to get everything into us.
Right.
Right. And then once the appraisal comes back and all of those documents are in and finalized, now it's time where we're going to, you know, if we're doing a DSCR loan, we're going to lock your rate. And then we're going to go into underwriting. If we're doing a fix and flip loan and everything is in, we don't need to lock any rate or anything like that. And then the process of underwriting begins. So you basically have until that appraisal comes back to get everything in.
Right.
It's enough time. It's about a week to 10 days.
Oh, absolutely. Right. I mean, and so what my point is, a lot of times, and we hear this all the time, they're like, well, you know, it's the lender's fault. And every time it's, guess what? There was something in the file that was missing, right? And the better you start getting at it, and you see this all the time, people who own a lot of properties, people who have done well, they tend to either be organized to begin with, or they learn because their files get stuck to have to be organized. Right. And get all your stuff together as much as possible, right? And send that. Then you can always go back because you're going to have insurance. You're going to have the rider for, you know, who's the lender, blah, 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 all those types of things. And that's normal. But try to be more organized when you actually send the packet. It will work out for you much, much, much better.
Right.
So having said that, Rich, this has been absolutely awesome. We will put your contact info and hopefully lots of people reach out to you and do a bunch of business.
Excellent.
So great having you, man.
Thanks for having me. Thanks
you very
much,
guys. Have a good day.
Okay. Take care, everybody. Thank you.